Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, everyone. It is March 29th, last day of the quarter, last day of the month. So next week we'll start off with, April Fools. So let's jump into it. We do got a lot of economic data to go over today. We'll start off with the personal income. Now, some of these data is going to be off because what I mean by off is that because the government shutdown, we're still delayed on some of this. So, for example, personal income we normally would have here in February, so which was January showed it was down 0.1%, but expectations were 0.3% growth, and it came in at 0.2%. So, consumer spending and income normally would come in at the same time frame, and this is one that is delayed due to the government shutdown previously. So consumer spending was down in December at 0.6%. Forecast called for 0.3%. It only went up 0.1%. So again, people went up, but it didn't go up that much for personal income, and the same thing for their spending. So it kind of correlates with one another here. Now we got inflation news here. As you can see here, this is something that might surprise a lot of people. So this is the core. This is when you take out the food and energy from the PCE. The core inflation is the core PCE, which is personal consumption expenditure. And this is the Fed's favorite gauge for inflation here. Now, in December, it went up 0.2%, and forecast for January was supposed to be the same level at 0.2%, and it only went up 0.1%. Now, however, if you look at the year-over-year result, this actually dropped below the Fed's target rate of 2%. So this went from 2% down to 1.8%. Uh, Now, on the other hand, the headline, when you do include food and energy, because energy has been coming down, it went down 0.1% for the month, the headline. So when you take out, and its year over year had a bigger drop. Its year over year went from 1.8% down to 1.4%. This is kind of shows you the volatility of food and energy, or energy, food and energy could have on the numbers, and that's one variable that we that's not a controllable group. So this is why they do a core, so they can show what they can control. Let's kind of move on here. We got another page of this. We got the new home sales for the month of February. We had 636,000 in January new home sales. Forecasts were calling for 625 annualized new home sales, and that actually increased in February at 667,000. So with this, we'll have to kind of wait and see how home builders are going to be feeling. So even though new home sales have picked up, we'll have to kind of see if they are feeling a little bit more confident about where things are moving towards. As we saw earlier this week, the confidence was down a little bit, as well as but that I believe that was an earlier reading, as well as building permits, and I think that was right around January. We saw those those reports. We got manufacturing in Chicago region, which is the index here is Chicago PMI, and in February we had a nice little boost in there at 64.7, but it did drop a little bit down to 58.7. Anything above 50 is still considered good. It's expanding or optimistic. So things are still in a decent area for the month of March and for the Chicago region. Last but not least, we got the consumer sentiment. This is Michigan State, I think, survey, or University of Michigan, excuse me, University of Michigan survey that sent out to kind of gauge consumer sentiment. And as you can see, it went up a little bit. So the previous month in February was at 97.8. It was supposed to be kind of the same sentiment, and it actually went up a little bit to 98.4. So people are feeling a little bit better in March than they were back in February, because it did drop a little bit due to, again, people were not thrilled with the government shutdown and everything. And of course, the stock market was a little bit more volatile at that point as well. But now that things are picking up again, they're feeling a little bit better about where things are at. Right now, today, the stock market is up. We had some good news. It looks like more progress has been made between our cabinet level negotiators between the U.S. and China. They conclude their meetings, and then they're going to meet up again next week, where China will be coming to the U.S. So they'll continue their talks. But it looks like this could be a pretty comprehensive trade agreement here, where they get into the technology and how to go about it. So this is probably something that could really, once it's done, this could really help out the stock market, primarily because especially give them a little more time to read into it. But again, it's the reports are coming out that this could be a very comprehensive report agreement between both sides here, and could really give even an extra boost to the stock market as a result. But the other thing that could deflate that extra boost, of course, is the whole Brexit talk. So that may overshadow this as well. Let's kind of move on and see how the bond market is reacting to all this. So the bond market is down. The mortgage-backed securities is down 8 basis points right now. And with yesterday's loss, this would kind of tend to lead us into a little worse pricing. Not so much from yesterday, but the day before. Pricing has worsened a little bit since then. So yes, today I would go ahead and say pricing will come in a little bit worse than what we saw recently as a result. And and treasuries have increased a little bit. So we were down quite a bit, down to like 2.37 or so, or maybe even a little bit less. Now we're up to about 2.42 if you want to round up on the 10-year treasury here. So again, mortgage rates slightly higher today as a result heading into the weekend. Otherwise, you guys have a great weekend here. We'll look forward to see you guys on Monday. Thanks so much for watching. Bye-bye.